Hi everybody, how are you? This is Ebere Okoye, as most of you know, and we are going to go over the year-end tax plan and notes for today. Um, I figured the best way to handle this today, we're supposed to talk about the advanced tax strategies. Then we're supposed to talk about the BOI. Oh my God, that's a hot mess. And then what I was going to do was to pick up some case studies of some files that I'm currently working on for the year-end tax planning and kind of raise some of the issues that have come out so far from those. And then, of course, address any questions that may have. All right, so let us start with this Corporate Transparency Act. What in the whole world is actually going on with this? For those of you that have not heard, a court in Texas has ruled the whole filing of the BOI report unconstitutional, and they have filed an injunction. It doesn't mean that it's going to make it all the way through. It might still be struck down, and so that there will still be that filing requirement. What we've told clients is that for those that have already filed, there's nothing you can do. You've already done it. We're encouraging those that have not yet filed, maybe just get it filed, get it out of the way and be done. If they want it, they want it. If they don't want it, they don't want it. But if you want to wait, kind of like do a wait and see, I don't see that the 1/1/25 deadline can be enforced. What, we're 21 days away, well, 22 days away from that deadline, and nobody has gotten any updates yet. So, I mean, you can do one of three things: ignore it and be like, you know what, I'm still going to go ahead and file, or you do something that's okay, let me wait and see if the federal court is saying it's unconstitutional, then I might as well just wait. Or you can, just make a decision that maybe before the end of the year, you'll get it done. I mean, there's a lot of businesses that they have to contend with, and I doubt that up to 10% have even filed that BOI reported. So let me know what you guys are doing. What are you guys doing about the BOI? Have you heard anything different from what I said? Do you have any questions um, concerning the BOI before we move on?
Hey, Ebere, this is Sam.
Hey, Sam.
So right now it looks like that's the only one that's kind of on the radar to file if you want to file, right?
Yeah,
Okay. And then the rest is wait and watch and see what comes out next year, I guess.
yeah.
Okay, cool. Thank you.
I found it weird though that like it's kind of weird like FinCEN would be requiring. It just seems like an overreach. But at the same time, it doesn't even take up to 8 minutes. Literally the longest time it would take is uploading your driver's license. So what I'm telling people is really you can decide how what you want to do. If you want to get it filed, get it filed. You don't want to get it filed, leave it alone. Want to wait and see, wait and see. Right now it's kind of like up in the air. HOA, who is the beneficial owner of an HOA? That's a very good question. So let us think about it. Um, isn't an HOA, maybe I'm mistaken, but isn't an HOA kind of like a community organization? Wouldn't it be considered a nonprofit? Would an HOA be a for-profit? I thought an HOA, an association, exists for the benefit of the homeowners. So I'm thinking, who are the office? It almost feels like it's kind of like a nonprofit, and I don't think those are required to file. I'm just following the same logic of nonprofits where it's for the benefit of the public, it's for the benefit of the homeowners in that community. So I am not thinking that an HOA needs to be filed. If anybody knows anything different, please feel free to speak up or to post. Okay, confirming that we should be filing that with the Secretary of State if we do file. No, it needs to be filed on the FinCEN website. Let me get the information and post it here. There is a link that they provided for filing it. It is filed on their website. You can actually do it while we're on the call. You will be done by the time we're finished. It literally doesn't take that long. So really you can do it while we're on the call. Hold on. Sorry, I'm trying to find I'm trying to find the link that I provided. Hold on, let me get it real quick. It's just coming up a lot because a lot of people were asking about it, so it's not easily. And let me go to maybe October. Okay, there you go. So let me post it here. You can pick up the link here and then get it filed. There you go. I also did a video on it at the beginning of the year, the 5 things that you need to know about the Corporate Transparency Act. So feel free to use that information. All right. I think you're correct about HOA. This entity is tax exempt. Yeah, I think that entities that are tax exempt do not need to file this. I think it operates more like a nonprofit. All right, any other questions on the BOI reporting before we move on? All right, so the next thing that I'm going to cover right now is what I call our advanced strategies. I will be sending the article later on this week, along with the links for the video, the 2 recordings that we've done. So last week we covered kind of like the basic things that you need to know about year-end tax planning. So today I'm going to cover the advanced strategies, some of the advanced things that we look at when filing, and then we are going to look at some case studies. So let me share my screen. Share my screen. Can everybody see my screen? Let me move this. You might need to unmute yourself to say yes if you cannot see my screen, or no, or something like that, because I can't tell. I can't see in the chat if you guys are able to see it, but I'm assuming that you can. Okay.
Yes, we can see it.
Okay, thank you. So let's go over the advanced strategies. Like I said, we went over the first 10 basic year-end tax planning checklists from last week. This week, we're going to go over advanced strategies. Why do I call them advanced strategies? They are advanced because these are things that are beyond the normal things that are done at year end. This is really for people who really made a lot of money and owe a lot. So now they're looking for ways to reduce their tax burden. The other reason why I call them advanced is because you have to spend money to save money. It's not one of those where we're kind of looking at your regular spending or regular business expenses, or if you have a rental property, we're kind of looking at those things to see how we can save taxes. Those are the regular things. For the advanced, you have to spend money to save money. So it's one of those things where, like, if you're in the 20% tax bracket, federal, 8% for state, so about 28%, let's just say 30%, and you want to save $30,000 on taxes, then you have to spend $100,000 to get a $30,000 tax savings. So that's why we say that it's advanced, because it's really for people, one, who have that kind of money and are looking for that high ticket item that could bring down their tax liability. So the first one is the oil and gas, because if you invest in oil and gas, you're able to use your drilling costs to offset your income, because that's going to be an active loss. So if you invest $100,000 in oil and gas, you can almost get like a $95,000 tax deduction in the first year, So for anybody who's looking for, like, you already were planning to invest in oil and gas, you think that oil and gas is a good investment on its own, it can help you to save on taxes, okay? The second one is you can 1031 into a large establishment investment property. So if you have a property that you bought, you sold within the last 45 days, because there's a 45-day period from when you have to identify the replacement property and 180 days when you have to close on it. So if you close on a property, let's say in November, you have till the end of the year to identify a replacement property. Now, that money should have been sitting with a qualified intermediary, because you cannot get that money at closing. If you get the money at closing, it kind of disqualifies the exchange. If you're thinking about selling a property between now and the end of the year, you could consider doing a 1031 and pushing it into the following year. If you do consider doing a 1031, or you have done a 1031 or are in the process of doing a 1031, please keep in mind that you cannot file your tax return until that 180-day period is over, because you need to ensure that it was not a failed exchange. So let's say this is what, December, you decide in 10 days that you're going to do a 1031. Well, your 45-day identification period starts counting, let's say December 20th. So you have 45 days, which would be, towards the end of January, first week of February. But you have 6 months, 180 days from December 20th, which is June 20th. Well, you cannot file a tax return by April. You have to file an extension and wait until June, or once you close on the replacement property. Why? Because if the property fails the exchange, meaning that come June you did not do that 1031 exchange, you would have to pick up that capital gain in the 2024 tax return. So you have to file an extension and wait until the 1031 is over in order for you to file your tax return. You can do the qualified opportunity zone. We know we have 1 more year on the qualified opportunity zone to defer taxes. There's kind of speculations that this is one of the things that the Trump administration will be addressing, and maybe they might extend the qualified opportunity zone. So if you have capital gains, whether it's from stock, it doesn't have to be from a property, it could be from stock, it could be any kind of investment. As long as it's capital gains, you can invest it in a qualified opportunity zone to get a tax benefit. You can also do charitable structure, where you can do, there's 3 kinds of charitable structure. Let me get to that. Yeah, the leverage charitable deduction. So let me get that. So there's 3 ways that you can save money when you do a charitable deduction, which is 1, you give in cash. That's really straightforward. For people who have a tax liability this year and you might be looking for ways to save on taxes, you first of all need to make sure that you're itemizing, because not a lot of people itemize these, often, because the standard deduction is now high. But for those that are itemizing, you could make a donation before year end and get a tax benefit. So let's say you're owing maybe $2,000, and maybe you already have $30,000 or $40,000 of itemized deduction. Think about it. If you're giving money regularly to your church, you give money, what, January, February, March? You could decide to give all 3 months or all 4 months in December, like put it on a credit card, get the tax deduction for it, and then just pay it down gradually. By doing that, you're able to get the deduction in 2024. Okay. You can also set up a donor advised fund. The donor advised fund is kind of like setting up a brokerage account where you gift the cash to the donor advised fund. You are able to get the deduction this year. However, you have time to designate the nonprofit that would benefit from the donor advised fund. So usually it's going to be like a DAF that's over 25 grand or under 25 grand, or you can do it as a directed contribution. So it's possible to make a donation before year end, get the tax benefit, and then decide later on whether it's next year or 2-3 years from now on the nonprofit that would benefit from that. But in order to do that, that's why it's called a DAF. It's still your account, but now it's earmarked for a nonprofit benefit, but you're getting the tax benefit this year. Okay. The leverage charitable contribution, that's another strategy that you can use, but again, it costs money. Where there's some charitable organizations that use, let's say, like precious metals or minerals or whatever, you would find a company, and there's companies that offer this, like if that's something you're interested in, they'll find, let's say, $30,000 worth of precious materials. You buy it, you donate it to the partnership, and then the partnership makes a donation to the nonprofit that uses it. Because you're buying it under value and you are donated it at fair market value, you get the fair market value as the deductible amount. So that's the benefit that you get by doing the leveraged charitable contribution. All right, there's also the solar strategy for those who want to invest in solar. You are able to carry that back 3 years. You're also going to get investment tax credits. So in a nutshell, that's kind of like the advanced tax strategies that we use in 2024. So I will pause now and take any questions before we move on. Let me stop sharing my screen. All right, any questions about the advanced tax strategies?
How do we get a copy of this?
We are going to be sending out the article along with the 2 links to the webinars, the one for today and the one from last week. We're going to be sending it out to everybody by the end of this week. Any other questions? Okay. So what we're going to do now is I'm going to do a couple of case studies. If I'm able to share my screen, I will. If I'm not, I'll just talk through it. And the goal really is to see some of our clients, what we are implementing for them to help them save on taxes before the year runs out. So let me see if I can pull up the first person and then we can take a look. Okay. So let me talk about this first person. Actually, you know what? Let me do it this way. It might be better that I pull up the actual spreadsheet so that you guys can follow along. Personal. Okay, here you go. I'll move this here. And move this up. Okay, let me share my screen. Here. Okay, so just let me know if you guys cannot see it, but this is the analysis. So usually what we do is we kind of look at what the client had in 2023 versus what they currently have in 2024. We identify the difference, and then we start figuring out the different ways that we can save taxes for them. So for this client, we can see that they have a regular job. So they made 126 at their regular job. This kind of decreased this year. Well, it wasn't really a decrease. It was because of the strategies from last year. They increased the contribution that they had to their retirement account. So which was pre-tax. That's why this decreased. Their business income kind of stayed the same. And then we can see that based off of their income, we can see that they had a significant increase in their business income. Business income went up almost $76,000. So with having income go up almost $76,000, our strategy now was, what do we need to do to save this person on taxes before the year runs out? So let us look at what they have. So right now we're showing that they are going to be owing $55,000 in taxes if we do not do anything. And the goal is there anything that we can do to bring down this $55,000 before the year runs out? So I'm trying to pull the sheet of the different strategies that we use for them. So the first thing that we did for them is that their business is in DC, so they have to pay DC franchise taxes. And then also because it's an S Corp, they pay themselves a salary. So they're also going to have the business franchise taxes and their own personal franchise taxes. So what we have them doing is that they're going to pay the DC franchise tax, the business one and the individual one, before year end. Because it is a state tax that they're paying, as long as they pay it before year end, they will get a deduction for it, which they're in a, I think, 30% tax bracket. So by paying, it's almost $11,000. They're saving almost $3,300 just by making that payment before year end. So that's the first strategy. The next strategy that we looked at, this is why you have a second scenario here, is where we have them contributing. They already have a solo K set up. They're going to contribute $35,000 to their solo K account. And this solo K contribution can be done after year end up to tax filing time, including extensions. If you do not have a solo case set up yet and you have business income, you can get the solo case set up and you get a $500 credit or a benefit. There's a $1,500 credit that is coming from the Secure Act. So, but you get it over 3 years, $500. So if you don't have a solo K account and you have business income, consider setting that up. You get that credit, but in addition, you are able to make a contribution to that. The next thing that we're doing is that they also have a 457 plan at work. Because they have a 457 plan at work, you are able to contribute to our 457 and you are also able to contribute to a 401k. So they're going to put in as much money as they can into their 457 account. All right. What else are we looking at here? Another strategy that they can use here to bring down their taxes is that if they wanted to put money into like a 529, even though it's only a state benefit, it is still beneficial for them to make this contribution to the 529 before year end. So what I'm going to do now is that I'm going to stop sharing and then address any questions before we look at the next case. What is a 457? The 457 is like a government pension. That's the best way of describing it. It's a government pension, but for some reason, you are able to contribute to a 401k and a 457, and you can do the maximum on both. It's not the same as like if you have a 401k and let's say like a SEP IRA, or you have a traditional IRA, all of those kind of interact. Or if you have a 401k at your job and a 401k at the business, you are able to make contributions, but you have to take the contributions across all the accounts. You have to take that into consideration. With a 457, you can contribute the full amount of, if you're under 50, 22,500, and do the same amount on a solo 401k, and that's okay for you to do because the 401k and 457 contribution limits are completely separate. A 529 is a college savings account that you set up for kids. If you know you have kids that are going to be going to college, you can set up a 529 for them. I'm not a fan of a 529 for two reasons. One, it's only a state benefit. Two, it kind of restricts the kids to go to school in a certain place. What I did was, rather than doing a 529 for my kids, I actually bought properties. And the goal was that by the time they're 18, which, I have two kids in college, most of those properties would have been paid off and they're able to use the funds from there to do school. And also, in lieu of doing a 529, I also did an IUL for the kids. I figured that getting life insurance for them while they're young and let the cash surrender value grow was of more benefit. Even though it's not a tax benefit, well, it kind of is a tax benefit because long term, they pay less because that is a tax exempt income. If they need to take out that money in later years because it's coming through an insurance, they're not going to pay taxes on it. Versus if they don't use the 529 for education and they end up taking a distribution from it, it will be taxed. So that's why I'm not a fan of a 529, but there are people who set up 529s all year long. You still get the benefit. It's still a state, only a state deduction, not a federal deduction. All right, any more questions on this scenario that I looked at before we look at another one?
Hey, Ebere, any use cases on Roth IRA?
No, but what do you want to know? We can discuss that now.
Oh, is there a cap on how much you can do the backdoor conversion for Roth?
No, as long as it's you first of all have to have it as a non-deductible IRA, and then you can now roll it over or transfer it to the Roth.
Okay, all right. I'll probably do some digging and maybe reach out to you via email if there are other questions.
Okay. When you bought the property for your kids, did you buy it in your name or in the kid's name? No, in our names because of the financing, but then it's transferred into an LLC. Any other questions before we move on? Okay. All right, let us look at one more. Well, we'll do two more. Let us look at one. Client LLC for the kids or still LLC for you? Okay, that's an important question. So let's take the time to address it. It is an LLC for us, but remember that as the kids get older, you can add them on as partners of the LLC. Now, you do not want them to have complete ownership of the LLC because the kids are able to get the property upon your passing and they will be able to get it at fair market value. If you transfer the LLC to them right now, they will be getting it at whatever basis that we purchased it in. So what I tell most people to do is to have the LLC set up and then give the kids like a very small percentage, like 1%, or 2%, and then you and your spouse or you by yourself own the rest of that LLC. Upon your passing, then your ownership transfers to the kids. One, you're still able to bear all the burdens and benefits of the property. You want to take advantage of depreciation and all of that going on. But two, it also helps you with estate planning where you're not having to deal with estate and probate and all of that. So the LLC is still going to be in your name, or you're still going to be the owner of the LLC, but then add the kids on as they get older. And then in the operating agreement, it specifies that if anything were to happen to you upon your death, that your lineal descendants take over that LLC. Can you set up 529s for great nephews and nieces? That's a good question. I'm not sure. I think it has to be I think it has to be your kids and grandkids and yourself. But I know that you're able to set it up for yourself, get the deduction, and then transfer it to somebody else. That much I know, but I don't know if you can set it up directly when it's nieces or nephews. So let me write that down and we can look into that and provide you with a response. All right, it's 10% too much. 10% of what? What about transfer taxes to the LLC? Okay, that's a very important question. When you have an LLC, when you have a property that is in your name and you have to transfer it into the LLC, not every county assesses a transfer tax or recordation tax or index or filing fees. So you kind of have to look at the county where the property is located to make that determination. If your property is in DC, absolutely, you're going to pay transfer taxes. But if your property is, let's say, in Montgomery County or Baltimore City, Baltimore County, Anne Arundel, you don't pay any transfer taxes. If your property is in PG, Prince George's County, you will pay transfer taxes. So it depends on the county where you're located. Now, some of the counties also give an exemption where they say if you transfer all your properties at the same time to that one LLC, then you can bypass the transfer taxes. So just to keep that in mind. Tanya, please give me more information on the question you're asking about 10%. Let me look at the next case. So this next client, let me pull them up. The situation that happened is they have a property management company. And in having a property management company, the business really did well this year, did very, very well having a property management company. However, now they have all these taxes that they now have to pay because the property did well. And not only that, they do have a kid, a child who works for the business. And so because the child works for the business, they also are paying the child every year under the business. So let me pull it up to let you know how we handle that. Hopefully this can come up. Okay. Share my screen. Okay. So as you can see here, oh, wait a minute. Okay. So this is not what you're looking at now are the final results. This is not what we had before. What we had before down here was where they were owing. Right now, you can see they're not owing anything. They were owing almost $20,000. This was as of yesterday because we just made the update today. What strategies did I use? When I looked at her business, she has a business where she has her son as the partner, but the son is also getting pay stubs from that business. And I told her if all her son is doing is just working for the business, he can have a capital ownership without necessarily having a profit and loss percentage. So we're going to do a special allocation where all the losses are allocated to her. So before the losses were like 20 something thousand, it's now 47 because all of it is going to her. Now for the property management company, this was at 78,000. You can see that that has come down to 37,000. What we looked at is when we looked at last year, if you look on here last year, you can see that there was a loss in the business. If you look down here, you can see that she had a total of $27,000 negative AGI. That is what I consider wasted deductions. She has $27,000 of expenses that were claimed last year that should not have been claimed, especially from this expense. So if we amend the 2023 return, that $28,000, she still would not pay any taxes, but then is released and amortized to be used in 2024. So when we bring that in to reduce this management company income, the income was able to go down from 78 to 37. And by doing that, she has rental properties is limited to 25,000. She no longer has a liability. And this is what she wants to hear. So we're going to be giving her that good news. The two main things to keep in mind with this, the strategy that we use for her is that when you have a child that is working in the business, it's kind of like the same thing that we're just discussing about the LLC and the kids. You can have your children have a capital ownership percentage, which they can have. It could be 50, 50, 60, 40. But when it comes to the profit and loss, you still want to bear all the burdens and benefits of that entity so that you are able to claim the losses if there are any. And if there's any income, you pay taxes on it. So she needs to just modify her operating agreement so that it's special allocation. Her son has a capital ownership and she doesn't. And then the next thing is not all expenses are created equal. It's possible that you have all these expenses in 1 year. It doesn't make sense trying to claim all those expenses in that current year if it's not going to do anything for you. If it's possible, amortize those expenses and then use those expenses in later years. All right, so I'll take any questions on that before we move on. What is that transfer also free in Washington, D.C.? No, transfer, unfortunately, D.C., it doesn't matter which way you shake it, as long as you're transferring a property from your name into the LLC name, you have to pay transfer taxes. So the question is, if you have a property in DC, how do you get the kids involved? Maybe setting up like a property management company and have them own the property management company. And then you can always have them take over that LLC subject to the existing ownership. So where they bear all the burdens and benefits of that property on paper, but it's not something where you can transfer that property into an, or you can, but there's going to be a lot of taxes that you pay on that. Yeah, I have my daughter. Oh, I have my daughter at 10%. Okay, there's a few properties there. I just heard you say you have to. Oh, it's not really a problem on the percentage. It's just what impact does it have? Like this client that we just looked at, you can see that doing 50-50 with his mom, he doesn't have a liability. So now he has all these losses in the business, but his mom has all this income because the property management company is doing well. So she benefits from the loss and he doesn't. But because of the operating agreement and because of the percentage that is handed over to him, she's owing taxes. So there's no fast rule. The reason why I say 1 or 2% is so that they have a very small share of the profit and losses. But how much percentage you give them really depends on how the business is performing and should they actually have any profit and loss ownership. Maybe they should just have a capital because you have to determine what your goal is. Is the goal to have them get some income, or is the goal for ownership? If the goal is ownership, then that's the capital percentage. Your capital percentage can be different from your profit and loss percentage by doing a special allocation. All right, moving on. So by having the kids on 1% ownership of the business, you have to file a partnership return. Is that? Yes, you have to file a partnership return. Okay, Tisha says she couldn't see the bottom of the sheet. I'm not sure which bottom. Okay, so we will look at, let us look at one more file and then, hold on, let me pull it up. I'm sharing my screen. Okay. So with this return, we can see that this client made $74,000 more this year compared to last year. That's a good thing, right? But if we go all the way to the bottom, we can see what happens. They've gone from getting a refund of $10,000 to now owing $5,000. And so the question is, what do we need to do to wipe this out? So usually what I do is that I try to go down and see what their what do you call it, their tax rate is. So their effective tax rate is about 18% federal, and then maybe another 8%. So about 30, it's still about the 30%. So in order to wipe out $5,000 of tax liability, we need about $15,000 of deductions that could be wiped out. So now I'm going back and I'm looking, where can we find $15,000? So one of the things is looking to say, have they maxed out or do they need to do catch-up contributions on their retirement account at work? We're going to look at that to see if there's any opportunity to get that done before year end. I'm looking here and I see that he has a business, he has interest and dividends. There's some stocks that could be sold that are already maybe stocks that are not performing well. And so if those stocks are sold, maybe more than a $3,000 loss, that's every little bit helps to bring it down. There is a business expense of $6,000. Could there be additional business expenses that maybe we're going to be incurred in January, February, March of next year that could be incurred by December on a credit card? Still gets it as a benefit, right? So for some of our clients, that's the reason why some of you pay our wealth building program in December, because you're able to get the tax benefit of that deduction this year rather than next year. So if your renewal is coming up January, February, March, you could just make that payment in December. I can see here that the client itemized. So if they're itemized, even though they have more deductions, are they able, same thing, whatever charitable contributions they would have made January, February, March, so first quarter of next year, can they increase the charitable contributions before year end and get that as a deduction? So somewhere between all these, because usually when I'm looking for ways to save on taxes, we don't want a situation where I tell you spend $1,000 to get 300 back. You've still lost 700. We're looking for expenses that you would have incurred anyway, things that would have been deductible anyway. And we're looking for ways that we could accelerate that deduction and bring it into the current year. Okay, I will stop sharing my screen and then answer any questions. Hold on. How does transfer taxes work if you have properties in a trust? It's the same principle. Please remember that a property that is in a trust, you do not get asset protection. It just helps you with probate and transfer and transfer deeds and all that upon your passing. But a trust is not a legal entity that protects you in the face of a lawsuit. Is there still time to create a 401k? Yes. You have until, well, the rules changed. It used to be that you have up till 12/31 to set up a 401k, but now you have until tax filing time to get that set up, and you have up till tax filing time, including extensions, to make the contributions. So we have a lot of clients who are able to take advantage of this because you have like till September of 2025 to make a contribution to a 401k and still get the benefit in 2024. So that's the beauty of being a business owner and having business income for which you can contribute to the 401k. So if this client, like the clients we looked at, two of them, they have a business, but one has income, the other one has a loss. For the ones that have losses, there's not much that can be done. But for the ones that have income, they are able to contribute. One person already had it, so we just say, hey, you can contribute. For the person that doesn't have it, they can get that solo cave set up. You get the $1,500 tax credit for setting it up, and then you can contribute. The contribution is based off of a percentage of your earnings that can go into that 401k account. Wayne, could you please explain what you mean? I'm not sure I understand the question. What if they are retired and making money with investment properties? Are you asking what the strategy is? Are you asking what the tax saving? Oh, okay. It depends on what you have going on. We have to look at, because it depends on how much income we're talking about. Like for those properties, has cost segregation been done on them? Is it even generating, the investment, the money that is coming from the investment properties? Are you making money from them? If you're making money from them, then was cost segregation done? And if you're saying that you're retired, we need more information. Like, are you retired and generating, like maybe you have retirement income, pension, and all that. So it's to look at all of that. And so to see what those possibilities are. What I'm going to do is to write down your name, and then we can look and do an analysis to see if we can make recommendations before year end. Yeah, so if you have pension and property investment, another thing that we look at is depends on what kind of income that property is generated. Because if it's generating income, you can prepay the mortgage to be able to claim the mortgage interest. Maybe depending on when the taxes are due, you can prepay that. If you have some repairs that you can incur this year rather than next year, you can go ahead and incur it. But everybody is different, right? So if I'm not looking at it to see what impact it may be, and it might just be where there's nothing you can do and you just have to, file the quarterly taxes and just pay the taxes quarterly. But I'll look to see what kind of income that is being generated to see what kind of strategies can be utilized. All right, son turned 18 in 2023. He works for an LLC. What are the tax implications and rules? Yes. So I'm glad you brought that up, because we actually, for one of the clients that we did today, that's an issue that is on their return. I found out that they hired their children to do work. Children are teenagers, but they didn't realize that if your child is on payroll but is under 18 years old, they are exempt from payroll taxes. They do not have to pay payroll taxes if they're working for the family business. So now they have all these taxes that they've paid that they're potentially going to get back. It's not a tax benefit like the taxes that we file, income taxes, federal and state, but it is a payroll tax benefit. But because we're already looking at it, we have to look at that to get the income taxes done. That's when I noticed it, and we're going to bring it to the client's attention. So they need to get that fixed before year end. And that's going to put some money back in their pocket, because now they need to ask for a refund on the payroll taxes that they paid for their kids. Now, if the child has turned 18, unfortunately, if they're working for the LLC and you are paying them income, they would have to pay self-employment taxes. This is not such a bad thing, because they can start to generate income that they can contribute to the Roth IRA. So even though they have self-employment taxes, they can contribute that money to a retirement account, still pay the self-employment taxes, but not have the regular income and the state tax. So that's the tax implication. Their income can no longer be exempt because now they're over 18. All right, any other questions? All right, if you guys don't have any questions, we could possibly end early, but what I wanted to see if there's any general questions, anything in general that you guys want to ask about or talk about before year end, anything at all. We usually also, advise when we send you out the form, we usually also ask you, right? Don't use year end as just year end for income taxes, like saving on taxes. Also do like your estate planning. Like, is your estate plan up to date? Is your will and trust up to date? Your healthcare directive, your financial power of attorney, is your beneficiary designation. If you had kids, review all your insurance policies. So kind of do all these financial checkup at year end. Even if it's not a tax benefit, it could benefit you in the long run in terms of wealth building, even if there's no tax implications. Okay.
Ebere, I want to say thank you for taking your time and sharing us this information because it was helpful. Thank you.
You're welcome. Somebody else is asking about a 457, so I'll go through it really quickly. For the 457, it's kind of like a government pension type thing. That's from the research I did. It's kind of like a pension. And so because it's a pension, contributed to it is not, the contribution limits for that does not impact the contribution limits for a 401k. Besides QuickBooks, is there another system that can interact with banks and or credit cards? Yeah, there's a lot of bookkeeping softwares out there. QuickBooks is not the only one. Quicken, you can use Quicken. Zero. If you're tied to rental properties, Buildium, we're actually doing an analysis of the different rental property management softwares that investors can use to manage their properties. And a lot of them will pull with the banks and pull it into the bank. So we're also going to, hopefully if that article is ready before year end, we'll send it. Otherwise, it will be sometime in January.
Ebere, what about if you at the retirement age and you want to start drawing out? I think it's like what, 63 or 65? Is there a strategy to use and drawing funds out when you at that age? Could you elaborate on that?
Yes.
Thank you.
Yes. Very, 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 very important question. It's important that you do the analysis of how much income you're going to get at 62 versus what you get at the official age, I think is like 66 and a half or something, and what you get at 70. So usually, I'm just going to give an example. At 62, you could get $1,000. At 66 and a half, you could get 1,500, right? And then at 70, you could get $2,000. So it seems that you're better off waiting rather than drawing your Social Security at 62 or 63, whatever, early, that it's better for you to wait till you're 66 so that you can draw more or even wait. But a lot of what we don't consider is the time value of money and also the money that you lose by waiting. So just to give you a quick calculation, somebody who would get Social Security of $1,000 a month at 62, by the time they're 66 and a half, that is 4.5 years. 4.5 years is about what, 54 weeks? So 54 months. 48 months, 4 years plus the half, 54 months. $1,000 every month for 54 months is $54,000. So that even if you did nothing and you started early, you can put that $54,000 in your bank. Now, come 66 and a half, when you would have gotten $500 extra. How long does it take for you to recover that $500? And that's the calculation that I do. So if you get $54,000 by starting early, when you get to 66 and a half, you would have gotten $500. If I divide that by 500, that means it's going to take 108 months to now be on the same footing with somebody that started early. If I divide that 108 months, divide that by 12, that is 9 years. So that means if you're 66 and a half plus 9 years, it is when you turn 76 that it would have made sense that you waited till 66 and a half to start drawing your Social Security. Are you going to be here then? Do you know what's going to happen with Social Security then? You kind of need to do that analysis before you turn 60, before you turn 62. Do that analysis of all 3 years, 62, 66 and a half, 70. There's also penalties, like if you're working at a regular job, but if you're completely retired, you're shortchanging yourself by waiting. Because even that 54,000 at 66 and a half, that money is going to be invested. If you invest that money properly, it could even be longer than 9 years before you're now break even by waiting until 66 and a half. This is why it's important to work very closely with your CPA or financial planner, your advisor. Make sure that you're working with your team to do this analysis for you. All right. Yeah, Tisha said it depends on how and what you do with your money. If you invest, it may be the same. Yeah, if you invested properly, it may be the same. Or if you invested where you even get like a 10% return, now we're talking rather than a 9-year difference, it's now a 12 or 13-year difference. All right, it is 4 o'clock, so we are going to wrap up. Any other questions before we wrap up? This is going to be recorded. It has been nice bringing to you guys the 2024 year-end tax planning. I'm looking forward to vacation. We will be done next week by the 20th, and then we're closed until the second week of January.
I have a question.
Mhm.
If I'm planning to do a Roth conversion from my rollover IRA to my Roth IRA,
Mhm.
if I have the brokerage company withhold the taxes,
Mhm.
do they send it to the appropriate?
IRS.
Yeah.
Yes. They will send the money, but keep in mind that a lot of times that the money that the amount that they withhold is usually not enough because they're not taking into account income that you have from other sources. Now you brought up a good point. I think it was Sam that brought this up earlier on. We usually tell clients to do an analysis before you do a Roth IRA conversion. Because with a Roth IRA conversion, you're paying taxes now. And so the question is, if you have $100,000, 30% tax rate, so now you pay taxes of 30,000, you're left with 70. Same question. How long is it going to take you to recover that 70 for it to have made sense that you did the Roth? What we do with a lot of clients is you can run a scenario to say, what is the ideal amount to convert so that I'm paying the least amount of taxes? We do that analysis for some of our clients every year. So rather than saying, oh, I'm just going to do a Roth IRA conversion of 100,000, maybe you should only convert 20 this year. And then maybe the following year you do another 20. And so you keep doing it until you're done rather than doing it all in the same year. Because if it's a year when you're going to be in a lower tax bracket, it's best to wait and do it then. Or maybe a year you're not working, or a year that maybe you just have all these losses from rental properties. So there is a way to do a proper analysis to decide how much of the Roth can be converted.
Okay. Yeah, this is a year that I was unemployed, so my
Yes. So
very low.
if I have to do a quick analysis, if it's a year that you're unemployed, and you were unemployed the whole year, then I'm looking at least maybe 30 or 40. If it's a year where maybe you worked, then it might be 20. The bottom line is doing the analysis of how much can you convert this year and still keep you at the lowest tax bracket, let's say at 10% 10% tax bracket. You do that analysis. And then what's the plan for next year? Is the goal, are you planning to get a job? Are you thinking about retiring or whatever? If the goal is that you're going to retire anywhere and you're going to be done, then maybe you can do the rest of it next year. So you're splitting it between 2 years rather than picking it all up in 1 year. Because the higher the amount that you convert, that also puts you into another tax bracket.
Right. Okay. Thank you.
You're welcome. FinCEN, I kind of covered that at the beginning. It does not have to be filed. There is an injunction that is saying that people don't have to file it. There's an injunction that was filed in Texas court. But what we've told people is it's your choice if you want to file, if you want to wait, if you want to just get it over with. Let me repost here the link to get it done so you can get it done. All right, everybody, have a Merry Christmas, Happy Holidays, Happy New Year. I wish you the best in your invest in life. And I look forward to many more years of working with you guys. Take care. Bye-bye.
Bye-bye. Thank